Yeah, good morning. Yeah.
Morning, sir. Good morning.
Okay, can I start the session?
Yes, so I'll
Please,
just give
sir.
a brief introduction about you and then you can start the session.
Okay.
Good morning once again to all our participants, both here and joining us online. Welcome back to the second day of our 5-day faculty development program on the topic Taxation and Society, charting the intersection of policy, philanthropy, and development. We hope yesterday's session provided you with the valuable insight into income tax and its intricacies. Today, we have the pleasure of welcoming a highly respected professional, Professor Jaideep Das Gupta, sir, who will lead us through a crucial topic residential status of individuals, HUF, and companies. Professor Jaideep Das Gupta is a distinguished professional holding the title of Fellow Chartered Management Accountant (FCMA) and an alumnus of XLRI Management Development Program. He brings with him extensive experience from his tenure as the ex-chief of internal audit at Flat Corp, where he oversaw operations in Dubai and Turkey. His earlier professional journey includes significant contributions at Timken India, where he played a pivotal role in financial and audit functions. With a career spanning international finance, audit, and management, Professor Das Gupta has not only excelled in the corporate world but has also made impactful contribution to academia. His deep understanding of financial regulations and tax laws, both domestically and internationally, makes him a highly sought after expert in his field. In today's session, Professor Das Gupta will be demystifying the complex legal aspects of determining the residential status of individuals, Hindu undivided families, that is HUFs, and companies, an essential factor for tax liability in India. This session promises to be highly insightful for those looking to understand how residential status influences taxation both for personal and corporate entities. We are privileged to have Professor Das Gupta with us today, and we are sure his expertise will add immense value to our understanding of this topic. So, without further add ons, let us welcome Professor Jaideep Das Gupta to take us through today's session. Over to you, sir. Welcome, sir.
Thank you, Rana. I think it was a very highly overstated achievements of mine. Very ordinary professional, just like everybody. So thank you, Rana, once more. To everybody, a very good morning. Uh, I would be taking this session on residential status. So at the outset, why is this particular topic so important for tax professionals or for others? Because if you see the basic topics in taxation, and we are referring to the Income Tax Act of 1961, the basics, the residential status, and exemption are the three topics or three areas which is true for the entire Taxation Act of 1961. These are all, like for example, salary. Salary is something which is true for itself as a head of income. Capital gains as a head of income. But there are certain things like residential status, exemptions, and the basics which cover the entire Income Tax Act of 1961. So one of the things which is very important for as a residential status. So today we shall be learning a little more into that. I'm sure many of you are very much insightful into this particular topic. So when we talk of residential status of in India, there are actually five different say entities for whom residential status exists, and they are the individuals, the Hindu undivided family or the HUF, the firm and the association of persons, a joint stock company, and every other person. So, what the residential status tries to do, along with further deliberations which we will have, it tries to fix on whom the tax amount of tax, because we all know there is taxation we have to pay tax, but it depends to a large extent on two things. One is the residential status and another, which is income. A product of the two leads us to understand the tax liability. So one is the residential status, another is the income. Both, when taken together, tell us whether a person will be taxable or not. So the very first thing is the residential status. Now, as I said, there are actually 5 entities into that: individuals, HUF, these two on one side, and the remaining thing forms association of persons, company, and every other person on the other end. Why it is so? Because as far as the first two are concerned, that is an individuals and an HUF, there are 3 particular status of that for an individual. Whereas for the remaining ones, whether it is a company or a firm and uh, association of persons and every other person, there are just 2. So, as far as the individual is concerned, there are 3 status: resident and ordinary resident, resident and not ordinary resident, and non-resident. Similarly, it is the same thing for HUF, but for the remain rest free, AOP and companies and every other person, it is either a resident or non-resident. Now the question is, why do we have these 3 for only the first 2 and not for the rest? Right. So we will go deliberate upon these things. So the first of all thing is, the moment we take up an individuals and we try to fix a tax liability that such and such person has to pay, first thing we have to do is to decide whether that individual is a resident or a non-resident. So the test for that is a very simple. Okay. Right. So, as far as the individual is concerned, there is a basic test and an additional test. The basic test tells us that basic condition A, that the person is in India in the previous year for a period of 182 days or more, and B, or he is in India for a period of 60 days or more during the previous year and 365 days or more during the 4 years immediately preceding the previous year. So this is basic condition A and basic condition B. So the basic thing over here to see is that it is or. Either basic condition A you fulfill or you fulfill the basic condition B. A person might fulfill both the conditions, that is very good. So when you fulfill either A or B or both together, then a person becomes resident. So I repeat again, when we talk of the basic condition A, which says that a person must be in India for a period of 182 days or more, or 60 days in the previous year and 4 previous years to the previous year, must be 365 days in India. Why this has been done? Because lots of people like you and me and most of us who are residents now, we easily cross the 182 days. But there are lots of people who keep on traveling, going abroad and coming back. So for them, possible it has been done an alternate rule which says that if you cannot fulfill the minimum amount of 183 days or more in the previous year, then there is an alternate rule for them that you be in India for 60 days in the previous year and 4 years prior to that, you are in India for 365 days. Right. It means that the previous year, now this is 24-25, the previous year is 23-24. So in 23-24, you are in India for 60 days, and before that, 22-23, 21-22, 19-20, and 18-19. Those 4 years, you are in India for 365 days. Now, it doesn't mean that you have to be all 365 days in any 1 year. There can be, you can be have 0 in 1 year, but overall, the previous 4 years to the previous year, you must be in India for 365 days. So the two conditions, basic condition A and basic condition B, is 182 days or more, basic condition A, or a very important thing is or 60 days in the previous year and previous to the 4 years to the previous year, you are in India for 365 days. So the moment you fulfill this condition, a person becomes a resident. So, however, as far as individuals are concerned, the moment a person becomes a resident, there is an additional test of resident and ordinary resident. So, moment a person becomes a resident, then that person has to undergo another test, and these are called additional tests. What are the additional tests? The additional tests are that he has been resident in India at least 2 out of the 10 previous years immediately preceding the relevant previous year, and additional condition and. Remember, over here it is and, not or. He has been in India for a period of 730 days or more during the last 7 years immediately preceding the relevant previous year. So, as far as the basic conditions are concerned, there is or 182 days or 60 days, and 4 preceding year to the previous year 365. A and B में there is what you call or. लेकिन the moment you come to additional condition, then it is 2 out of 10 years additional condition A, which you must be resident in India and you must be in India for a period of 730 days or more during the 7 years immediately preceding the relevant previous year. So, if a person fulfills both the conditions after fulfilling the basic and both the conditions of additional A and B, the person becomes resident and ordinary resident. However, if a person does not fulfill any one of the additional, either A or B, or he does not fulfill both the conditions, then a person becomes resident and not ordinary. So the basic thing over here, the understanding is both the additional conditions must be fulfilled by an individual to be called a resident and ordinary resident. Like most of us in India, we are all residents in India, staying for many years. But if you do not fulfill even one of the additional conditions or both, it doesn't matter whether you fulfill both or not. The moment you fail in one of the additional conditions, that very moment you become a resident, yes, but not ordinary resident. So that is as far as individuals are concerned. Now, when I do not fulfill any of the basic conditions, and that is 182 days or more in the previous year and 60 days in the previous year with 365 days previous to the previous year, 4 previous years. If I do not fulfill anything, the story stops there. I immediately become a non-resident. Of course, now there is an exception to that also. In spite of one being a non-resident, there have been 2 exceptions brought in that if you're having a 15 lakh income, leaving out your foreign income, then you are still considered a resident and not ordinary resident for taxable purposes. So this is the rule of individuals. However, to this particular rule, there are 2 exceptions, because we say that the basic rule is 182 days or more in the previous year and or 60 days and previous 4 years to that you must be in India for 365 days. But this has got an exception, this particular thing. For 2 things, for 2 exceptions, only 182 days is taken, and the next one or 60 days is not taken. Only 182 days. It comes in 2 cases. One, if a person, an Indian citizen, goes out for employment, or if you are a member of a crew of a ship. So what happens if you are a person who is going out of employment? It might be that you are employed in India and your company has transferred you to a foreign country for your services. It applies there. Or if you are a unemployed person who has gone out abroad to take up employment, it applies even to that. In both these cases, only 182 days in the previous year is taken, and the second basic condition B is not taken into account. Similarly, if you are a member of a crew of a ship, Indian ship, then again only 182 days or more in the previous year is taken and not the 60 days. Now, apart from that, there is another, this is exception 1 to the basic rule. There is another exception to the basic rule, and that states that if a person, Indian citizen or person of Indian origin, comes to India for a visit, then again only 182 days in the previous year is taken and not the second alternate condition of 60 days. The issue here is who is a person of Indian origin. A person of Indian origin is a person whose parents or grandparents were born in undivided India. means before 15th of August 1947. And this includes both maternal and paternal grandparents. It includes from both sides. So a person who's of Indian origin means whose parents or grandparents were born before 15th of August 1947 comes to visit to India. For that person, it is only 182 days, not the or that is 60. And for exception one, which I had already said, if you go for an employment, whether as an unemployed person or whether your company has transferred you to a foreign land or you are a member of a crew of an Indian ship, again, only 182 days is taken. So this is the main crux of the rule for residential status for individuals. I will quickly repeat because many times this becomes a bit confusing. There are A, B here and A. So I will just, to make it easy for everybody to understand, just quickly go through the rules over again once more. So we are dealing with the Income Tax Act of 1961, which has a topic called the residential status. This residential status covers the entire Income Tax Act of 1961. Everywhere it applies. And it applies for what? It applies to determine who is the person who's taxable. Because we cannot tax a person who's an NRI earning foreign incomes. So whom do we tax? Along with this, we take into account the income. A product of this, the residential status and the income tells us which income is to be charged on whom. So the rule for individual, I repeat once more, is basic condition A or B. The basic condition A is that the assessee, the person, must be resident in India in the previous year for 182 days or more. What is previous year? This is currently we are in 2024-25. The previous year to this is 2023-24. This is the assessment, that is the previous year. For this 24-25 previous year, the assessment year will be 25-26. So that is the basic condition A, that an individual must be in India for 182 days or more, or he must be in India for 60 days and 4 years prior to the previous year, he must be in India for 365 days. That 365 can be spread out, not necessarily that it has to be only in 1 year, in the 4 years previous to the previous year, right? Rather previous to the previous year, before the previous year, 4 years. Now this is the basic condition. Both is or, there is an or. Now if a person does not fulfill any of the condition, the person becomes a non-resident. Now with some amendments in the last 2 years, a rule has been brought in that even if you are a non-resident, if you're earning an income of 15 lakhs in the previous year, which does not include your foreign income, then you become a resident and not ordinary. So that is for NRI. Previous to that, we used to say that the moment you don't fulfill condition A or B, you become a non-resident, there is a full stop, nothing to do with you. Now what do we say? In spite it's not a full stop, there is a comma, you become non-resident, but if your Indian income is more than 15 lakhs, excluding your foreign income, you become a resident and not ordinary. So that is basic condition A and B. So the moment an individual becomes a resident, there is a further testing. Is he a resident and ordinary resident like most of us, or is he a resident and not ordinary? And I will tell you why we do that. So the additional condition is additional condition A and additional condition B. There is an and. In the basic, there is or. What is the additional? You must be in India in 2 out of the 10 years. You must be resident in India and you must be present in India for 730 days out of the last 7 years, right? So you have to fulfill both the conditions to become a resident and ordinary. If a person fails even one or both, the person becomes a resident, already is a resident, he becomes resident and not ordinary. Now the important thing is, the listeners, the audience here might be having a question that why do we need to know for individuals resident ordinary, resident not ordinary? That is because as far as the resident and not ordinary is concerned, they are only paying taxes on income only on 2 incomes, for a business or for a profession, right? For a business which is controlled wholly or partly for in India, or any professional lawyers which is set up in India. On no other foreign income do resident and not ordinary residents pay any tax, only on 2. So that is the basic rule of our individuals, which is, I have just given you the gist, the main parts of the rule. which is there. So that is one part. So we have come to know about the rules of resident and ordinary. Now, going out from this, there is another entity. We have spoken about individuals, and there is another entity which is called Hindu undivided family. The rules of individuals and Hindu undivided family match to some extent. Extent means there also we have three status: resident and ordinary, resident not ordinary, non-resident, right? And the rules for additional condition is absolutely similar to individuals, but the residency status is slightly different, right? So Hindu undivided family, what is the rule for a residency for a Hindu undivided? It's a joint family kinds of a business. So what is the rule for that? The rule for residency for an HUF is that if the control and management of the HUF is wholly in India, or the control and management of the HUF is partly in India and partly outside India, no percentage given, then that HUF becomes resident. If that HUF is being controlled completely from out of India, then it becomes a non-resident. So the rule for residency as far as the HUF is concerned is very clear, that the Hindu undivided family's control and management must be wholly in India or partly in India. Partly in India, partly outside India, no percentage has been given. In that case, the HUF becomes resident HUF. If the control and management of that HUF lies completely out of India, then that HUF becomes non-resident. Now the question is, what do we understand by the word control and management? What do we mean by control and management? Control and management means taking the key decisions of a business. What are the key decisions of business? What to purchase, at what price, how much to sell, at what price, whom to employ, how much rent to pay, or how much of advertisement in which newspapers, which television. These are all control and management, so it is done by the seat where the power is. Now this entire power must be in India or partly in India. So the control and management means who is controlling it, from where, all the business decisions, and from where this particular business decision is being taken. So if a particular business is being controlled totally from Canada, where all the decisions are taken from Canada, then obviously it is a non-resident HUF. It is not resident. However, if it is partly from Delhi and partly from Canada, then it is a resident, or the entire decisions, control and management is done, let's say from Pune. It is completely resident in India. So the question is, what happens if the owner, let's say the person who's in Canada, comes to India on a vacation, and he has a house in India, and he goes there, stays for some days, does some farming, then he goes to another part in India to have some birthday celebrations and calls over friends to have a party at his house. After doing all that, he goes back to Canada. This will not make the HUF resident. Why? Because the control and management, he may have come here, the Karta, as we say. HUF means Karta and Kopaksena. The Karta, who's an equivalent to the MD of a company, or the controller of the company, comes to India on a vacation. That has nothing to do with control and management. If the control and management is being done from Canada, then it still remains a non-resident, because the person came here merely to tour or to spend some time in India. Right. So as far as HUF is concerned, the rule is very clear. If the control and management is wholly in India, it is resident. If the control and management is partly in India, partly outside India, it is still resident HUF. If the control and management is completely out of India, it is a non-resident. Now the question is, I told you that like individuals, HUF also has three status: resident and ordinary, resident and not ordinary, and non-resident. So we have understood who's a resident, who's a non-resident from the basic conditions which is there. The question is, if the HUF becomes resident, then what do? We have to test like individuals for resident and ordinary and resident and not ordinary. And in this case, the additional rule of individuals is absolutely ditto same, except that in place of individuals, we put the word karta. So, if the karta, if our HUF is resident, matlab it is only being controlled and managed from India or partly from India, then we have to go for additional conditions to see whether the HUF is resident ordinary or resident not ordinary. For that, if the karta of the HUF is resident in 2 out of 10 years, and if the karta has spent 730 days out of the last 7 years in India, then that HUF becomes resident and ordinary. You must have just marked that it is the same rule of additional for individuals, only that in place of individuals we use the word karta. So if the karta, so here the karta stay. Karta is who? He is the basic, like the MD of the whole and soul of the HUF, who controls the HUF. So if the karta is in India for 2 out of 10 years and 730 days out of the last 7 years, that HUF becomes resident and ordinary resident. If the karta does not fulfill even one or both the additional conditions, because it is and, that HUF becomes a resident and not ordinary. So the taxability from the point of view of residential status, that is what it is for an HUF. So the HUF rule, as I told you, is very similar. The additional rule for individuals, but overall it has also got 3 status: individuals, resident and ordinary, resident not ordinary, and non-resident. So I have told you the rules of the 2 things: individuals and HUF. We come third to companies. Now, as far as companies concerned, the rules are different. They are not like individuals and HUF. And further, a company can be either resident or non-resident. There is no question of resident, ordinary, resident, not ordinary, etc. Just true. So, as far as the companies are concerned, the basic condition is that an Indian company is always resident. The first basic condition. An Indian company which is registered in India is always residential. Means what? See, we have got a register of companies in every state, right? So, where a company, I am from Jamshedpur, so we are more used to Tata Steel and Tata Motors. So, Tata Steel, Tata Motors are registered with the ROC at Jharkhand. So, that is an Indian company. Now, it will remain so even if Tata Steel's 100% shareholding is held by non-resident Indians. It will still remain an Indian company. So it means an Indian company which has been registered under Indian laws in India with the ROC of the respective state, it does not matter even if 100% of the shareholding is held by foreigners, it still remains an Indian company. Hence, an Indian company can never be a non-resident, it will always be a resident. So that is the first thing about company. So basic rule is Indian company remains an Indian company. Now, what is a foreign company? A foreign company might be somebody who has got a subsidiary in India. So moment we come to a foreign company, we have to understand their residential status from 2 things. The 2 things are the turnover. So, if the foreign company whose turnover or gross receipts in the previous year is more than 50 crores, and the foreign company whose turnover or gross receipts in the previous year is 50 crores or less. So, a foreign company whose turnover or gross receipts in the previous year is less than 50 crores is always non-resident. So, that is again very simple, very clear. Means a foreign company whose overall turnover, gross receipts, sales, etc. in the previous year is less than 50 crores will be a non-resident company. It will not be resident. In case of a foreign company whose gross receipts or turnover, sales, etc. is more than 50 crores, for that, if it is there, then we have to make a test. And the test is POEM, or as we tell to various people, Kavita. It becomes very easy to understand. Poem means place of effective management, very much like our for our Hindu undivided family. Poem means place of effective management. So, if a foreign company turnover, gross receipts in the previous year is more than 50 crores, then we have to look into the POEM, P.O.E.M, place of effective management. If the place of effective management is more than, if the turnover is more than 50 crores, then the place of effective management. What is that? That is from where the controlling is being done for the company, the decisions, the control, etc. So if the place of effective management is in India, then that foreign company is resident in India. If the company whose gross which is turnover foreign company is more than 50 crores, but its place of effective management is abroad, which is being controlled not from India but from abroad, place of effective management, then that company becomes non-resident. So as far as companies are concerned, the rule is very simple. Indian company remains Indian company no matter even if the entire shareholders are foreigners, NRIs. A foreign company, we have to look into the turnover less than 50 crores, more than 50 crores. That is the turnover, gross receipts or sale. If the turnover is less than 50 crores, it is a foreign company, no, it is a non-resident. If the turnover is more than 50 crores, we have to look into the POEM, place of effective management for the foreign company. If that foreign company's place of effective management is in India, it is a resident company. If its place of effective management is abroad, not in India, it becomes a non-resident company. So this is for the company. So we have done the rules for individuals, for HUF, and for companies. And there is another rule for determining the place of resident status of a firm and association of persons. That is very simple. Either it's a resident, non-resident, it is very much like HUF. If the firm or the association of person, if its control and management of the firm and AOP is wholly in India, it is resident. If it is wholly outside India, then that firm or AOP, association of person, becomes non-resident. If it is partly in India, partly out of India, that is the control and management, then it is a resident. And for every other person, so we have done 4 and the last one is the residual, every other person, same thing. Every other person means if there are not in this 4, individuals, HUF, company, firm, AOP, any other status which comes to reckoning, every other person is resident in India if the control and management of its affairs is wholly or partly situated within India during the relevant previous year. On the other hand, every other person is non-resident in India if the control and affairs is wholly situated outside India. So we have done status of all the 5, individuals, HUF, company, association of persons, firm, and every other person. So this is the rule for residency of these. Now, coupled with this, what do we need to know is the income. Because one that we have understood is what is the residential status. But why are we talking of the residential status? Ultimately, our aim is to know on whom we can charge the tax in India. So one is residential status, that we know. The other and the equally important part is income. So there are 2 incomes. Either that income is Indian income or it's a foreign income. So how do we understand whether that income is Indian or it is foreign? So again, there is a rule, very simple rule. The rule is if that money is received in India or deemed to be received in India. So to decide whether an income is Indian income or foreign income, 2 things are taken. What are the 2 things taken? Whether income is received or deemed to be received in India during the previous year, and the second is whether the income accrues or arises or deemed to accrue or arise in India during the previous year. So there are 2 things. I will explain in a more simple term. It means whether the money has actually received or has been received. Whether in our territorial Indian territory that money has been received or it is deemed to have been received. And number 2, whether it accrues. This accrues because moment we talk of having received in India, it's very simple. We all understand, okay, the money has been received. But what about accrual? So I will give an example. Let us say a person working in Tata Steel Jamshedpur. There is an SBI State Bank of India just beside Tata Steel, and they credit the salaries to the State Bank of India. So a person working in Tata Steel for this current year, receiving salary in State Bank of India, obviously has received as an income in India, and it accrues also, means mehnat, uska jo mehnat hai, his efforts, etc., it is all in India. So it is accrued in India, means it accrues in India, it is an Indian income. It is not an income which America or UK can claim. It is an Indian income. Indian government can lay a claim on that for taxes. So whether an income accrues or arises in India, meaning is where is the effort for that? Where has the work been done? Which country deserves it? So somebody working, let's say, in the Bank of Baroda in Delhi and getting his salary credited to Bank of Baroda Delhi, it accrues in India. That person is in India, he has received in India. So if the income is received in India and it accrues also in India, both yes, then the status of the income becomes Indian income. So the very first thing which we come to know, that if both the things are in India, the amount of the money has been received in India and also it accrues in India, then it is an Indian income. The second one is, we will go for permutation and combination. The second one is, money is received in India, but it does not accrue in India. It is still an Indian income. I will give you an example. Person is working in Kuwait and his salary is directly transferred by his Kuwait employer to India, to the State Bank of India in Delhi. Right. So the money has been received in India, but it does not accrue in India. It accrues in Kuwait. But since the money has been received in India, it is an Indian income. The third permutation, money has not been received in India, but it accrues in India. Means a person worked in India in Steel Authority of India Limited for 30 years. After working that, he goes and settles in New York with his son and daughter. He goes there. The Indian government sends his pension every month to USA and America and New York, where he stays. The money is not being received in India, but it accrues in India. Why? Because he's being paid that pension because of his 30 years of service. So it accrues here, although it is not received here. So the first condition is income received in India, accrues in India, it is Indian income. Second case, money received in India does not arise in India, it is still Indian income. Third case, money is not received in India, but accrues in India, it is an Indian income. And the last case, money neither received in India nor accrues in India is a foreign income. Mr. John of the Bank of America working in New York, staying in New York, receives his monthly salary in the Bank of New York or Bank of America. It is not received in India, nor does it accrue in India, because both are, it is an American income, American citizen, so it is a foreign income. So now we have understood, first we understood what is the residency status for different individuals, HUF, company, firm, AOP, and every other person. Next we understood what is Indian income, what is foreign income. Right. Now, having understood both these things, when we multiply this, we will understand what is actually taxable in India, right? So let me go one more step, the main step which determines, so an Indian income. Now what I'm doing, I'm using the second, our study, the second part, Indian income and foreign income, and using it, connecting it with our residential status to make you understand how it is taxable. So the moment it is an Indian income, it is taxable on everybody, whether that individual is a resident and ordinary, whether that individual is resident non-ordinary or a non-resident, right? For an individual. So if that Indian income, if it is an Indian income, means either it has been received in India and also accrues in India, or received in India, does not accrue in India, or is not received in India but accrues in India. If it is a resident, if you are a resident and ordinary resident, it is chargeable on everybody for an individual, whether you are resident ordinary, whether you are resident not ordinary, whether you are non-resident. If it is an Indian income for individuals, it is chargeable on everybody. So we can just close our eyes and simply say, if it is an Indian income and you are an individual, it is chargeable to everybody, whether you are resident and ordinary, whether you are resident and not ordinary, or you are a non-resident. Now comes the foreign income. Moment it is a foreign income, it is chargeable on resident and ordinary. So whether you are moment you are an individual and you become a resident and ordinary, every income is chargeable to you, whether it's an Indian income or whether it is foreign income. So as far as individuals are concerned, it does not matter whether it's your individual income, whether you are a resident, whether it's your Indian income or a foreign income. If you are an individual and a non-resident, a foreign income is not taxable in India. Means you are a foreign citizen, the income is foreign. Indian government has got absolutely no what you call right to charge that income because it's a foreign income. Now we come to the individual, the second category, that is resident and not ordinary resident. In case of an Indian income, that person is also chargeable because, as I said, the moment it's an Indian income, it is taxable to everybody. But if it is a foreign income, resident and ordinary, everything chargeable, Indian or foreign. Non-resident, if it's a foreign income, cannot be chargeable. But if your status as an individual is resident and ordinary, not ordinary resident, only two incomes are chargeable in India. And what are those two incomes? One is that it's a business or profession which is controlled from India, or a profession which has been set up in India, like lawyers, doctors. If you have set it up in India, then it is chargeable. Except for these two incomes, nothing is taxable in India in case of resident and not ordinary resident. So I will quickly go because in one session it might be a bit confusing because there are so many points here. So it might be a bit of a jumble kind of a thing. I will just go through the entire rule once more. What is an Indian income? Indian income is that which is received in India and also accrues, both the conditions fulfilled. Yes, it is Indian income. Indian income, it is received in India but does not accrue in India or arise in India. It is still Indian income. The income is not received in India but it accrues or arises in India. It is still Indian income. The income is neither received in India nor it accrues in India. It's a foreign income. Now, connecting your residential status with the income, if you are an individual and you have a foreign, you have an Indian income. If it's an Indian income and you are an individual, then it is chargeable to tax to every residential status, whether it is a resident and ordinary resident, or a resident and not ordinary resident, or a non-resident. So Indian income, we can say, blindly closing our eyes, is taxable on everybody. However, if it is a foreign income, then it is very much chargeable to Indian resident and ordinary resident. It is not at all chargeable to a non-resident. In case you are a resident and not ordinary resident, only two foreign incomes are chargeable. And what are those two? If it is a business which is being controlled from India, or a profession which has been set up in India, like lawyers, doctors, etc. So what I have done, first we did the residential status for each of them. Then we understood what is Indian income, foreign income, and then we multiplied the residential status into the Indian or foreign income to understand who is chargeable. And why is this important? Because this is the basic point. Our tax rates are there, all those things are there, slabs are there, but we must know whom to tax. Most important. We cannot tax an UK citizen or an American citizen. We can charge tax to Indian, but how do we do it? The tax status tells you, residential status. So this status tells you very clearly on whom we can charge tax. So it applies on the entire residential and the entire Income Tax Act of 1961. Just to go ahead, I will just take a few examples to make this further clear to you, because the moment we do one or two examples, this entire thing of status becomes very clear. And what is that? Let us say that a person receives rental income of rupees 36,000 in India on May 10, 2023. It may accrue outside India or in India, right? And we say, okay, rental income 36,000 received in India on May 10, 2023. If that person is a resident and ordinary resident, but not ordinary resident, non-resident. In three cases, a person receives an income, a rental income of 36,000 in India on May 10, 2023. So the question is, suppose this person is a resident and ordinary, resident not ordinary, and non-resident. In case में, what will it be? Will it be taxable? So first of all, we have to understand the amount of rent received rupees 36,000 in India on May 10, 2023. The rule says what is Indian income? Received in India, accrues in India. So it has been received. It is more than enough. We are not concerned whether it has been accrued, even if it does not accrue. It is an Indian income. Hence, whether this individual is resident and ordinary, or a resident and not ordinary, or non-resident, it will be taxable across the board, right? It does not matter who that person is. Let me take another simple example. Income of rupees 66,000 is deemed to accrue or arise in India during the previous year 23-24. It may be received in India, outside in India. So again, now what have we done? An income of 66,000, it has not been received in India, but it accrues or arises in India. The case says. So is it taxable to whom? If that same person is resident and ordinary, the same person is resident and not ordinary, and the same person is non-resident. Since that income accrues in India, it is an Indian income. Remember the rule we said, resident ordinary rule we said, Indian income received and accrued in India, not received, accrued in India, which to this case applies. It is still Indian income. Therefore, in this case, it is an Indian income of the 66,000 amount, and it will be chargeable to everybody, whether that person is a resident and ordinary, or resident and not ordinary, or a non-resident, right? So we have done two cases, one where Indian income received, one where foreign income received, right? Now I will do two more cases, and very interesting cases, right? So this case will tell you a point which we discussed. The moment we understand the rule, we will understand it very simply. Income, business income, professional income of 76,000 received and accrued outside India during the year 2023-24. Business is controlled from outside India, or profession is set up outside India. So we are now doing a case of income which is received outside India. This is received outside India. This is in a business which is either controlled from outside India, or a profession which is set up outside India. So the question is, what if that person is resident and ordinary, non-resident and resident, but not ordinary? So as we said, if a person is an ordinary resident, resident or ordinary, it is chargeable to him. It does not matter. This is a foreign income because it is not received in India. It is received in a foreign land, and it does not accrue. The fourth point, income neither received in India nor does it accrue in India. Therefore, what is the answer for this? It's a foreign income. Even if it is a foreign income, it is chargeable to resident and ordinary. It is not chargeable to non-resident because we cannot charge foreign income to non-resident. But in the case of resident and not ordinary, it will still not be chargeable, because a resident and not ordinary is chargeable foreign income only in two cases. If that income is from a business which is controlled from India, or a profession which is set up in India. Hence, even the resident and not ordinary will not be taxable. So it will be yes, no, no. Yes for resident ordinary, no for resident not ordinary, no for non-resident. Now, the same case I change a little bit. Suppose in this above case that I just now told you, the business is controlled from India, or the profession is set up in India. That little change I made in that case, right? In the previous one, what did we say? We said it's an income which is received outside there, 76,000 business income, which is controlled from outside India, or the profession set up in India. Now, in this case, if it is a foreign income, but the business is now controlled from India, or the profession is set up in India. So a person who's a resident and ordinary, he will be chargeable to tax, because what did we say? It does not matter for a resident and ordinary whether it's an Indian income or whether it's a foreign income, everything is chargeable. Since it is a foreign income, it cannot be charged to a non-resident. However, in the case of a resident and not ordinary resident, this will be chargeable to tax, although it's a foreign income. Why? Because the business is being controlled from India, or the profession is set up. Only in the case of resident and not ordinary, only two foreign incomes are chargeable: when the business is controlled from India, or the profession is set up in India. In no other case, any other foreign income, be it salary, rent, or whatever income, nothing else is taxable to a resident and not ordinary. So what have we done with these examples? The main things I have just explained to you, the gist of the case, how this applies, right? So what have we done in this session? We first understood residential status for individuals, for Hindu undivided families, for companies, for firms and every other person, and from AOP and every other person. That we understood the rules. Then we understood what is Indian income, what is foreign income. And then we multiplied both of these to understand what is taxable to whom. We said that Indian income is taxable to everybody, whether the person is resident, ordinary, resident, not ordinary, non-resident. So as far as Indian income is concerned, no problem. As far as foreign income is concerned, resident ordinary taxable, resident not non-resident non-taxable, and resident and not ordinary, only two cases of foreign income are taxable if it's a business which is controlled from India or a profession which is set up in India. If the business is controlled from out of India or a profession which is set up out of India, even a resident and not ordinary resident foreign income will not be taxable in India. So the effort has been to explain to you. So this entire thing applies to the entire income tax. Slab rates, etc. come later on. First comes, किसको हम tax करेंगे? Can I tax this person? Then we determine the age limits and the tax rates to actually charge the tax, right? So with this, I have completed the entire thing on residential status of income tax in India, 1961, right? So I hope you people understood, enjoyed it, got the gist of whatever I was speaking about, right? Was I clear to everybody, whatever we were talking about? It was a long session, I know, and lots of thank you, Anuja, madam. It's a long because it's to or do all this within 1 hour, this entire session, residential status for all these and income and chargeable. There are more things there, but that we have not covered, like some other forms of income, etc. Main things I've covered, right? So any questions that anybody has got? We have almost a little very time left over. I hope the session was useful for all of you. Are all of you in the commerce and management field or from other fields? If you're in commerce and management field, then obviously you can relate with it. If you're from other fields, then it's a very good information for you all. Hello?
Yes, sir. The session really focused on the legal aspects of determining the residential status, and which is also an important and crucial factor for tax liability in India. So really, the session was very informative. Thank you, sir.
Thank you, ma'am. Thank you very much. Right. So let me just ask the organizers whether, because it's almost time, we have got about 3 minutes left. Let me just see. Rana, we have actually, the session is over. So would you like to say anything or we close the session? बंद है दरवाजा.